This video is going to cover financial assets. Individuals, businesses, and governments borrow and save, so they need financial institutions to help. The financial sector refers to a network of institutions that link borrowers and lenders, and they include banks, mutual funds, pension funds, and other financial intermediaries. An asset is anything tangible or intangible that has value. An interest rate is the amount a lender charges a borrower for borrowing money. It's the price that you pay for borrowing money. Interest-bearing assets are things that earn interest over time. A good example are bonds. Personal finance refers to the way individuals and families budget, save, and spend their money. In a personal finance class, you'd learn about checking and savings accounts, credit cards, loans, the stock market, retirement plans, and how to manage your assets. So the things that you learned through the EverFi program during the first semester. The word investment in economics always refers to the business spending on tools and machinery. We're not talking about financial assets. Buying assets come with a variety of risks. You can have market risk, the chance that you might lose value as market prices fall and rise. Default risk refers to the chance that companies are unable to fulfill or pay their debt obligations, and you have this kind of risk with bonds. Or inflation risk, that the value of your investment could shrink or be reduced because of prices going up. Again, here, remember that the word investment we're referring to as financial assets in this case. This chart illustrates a variety of investments and their risk-return trade-off. So the higher on the pyramid the investment appears, the more risky it is. So there's a higher chance that you could make money, but also a much higher chance that you could lose your money. Liquidity refers to the ease with which an asset can be converted into cash. So in general, the higher the liquidity, the lower the rate of return is going to be on that investment. Pretend that you're going to start a lemonade stand and you want to borrow $100 from your grandma. Your grandma just bought a bond. Bonds are securities or loans. So in other words, IOUs. They represent debt that the government, a business, or an individual must repay to the lender. The bond holder has no ownership of the company and is paid interest. To get more money, you could sell half of your company and issue shares of stock. Stocks are often referred to as equities, and they represent ownership of a corporation, and the stockholder is often entitled to a portion of the profits that the company earns, and these are paid out in dividends. A bond is issued at a specific interest rate that does not change throughout the life of that bond. So if you invested in a 30-year treasury bond, and it had a face value of $1,000 and an interest rate of 5%, each year for 30 years, you would earn $50 in interest. If the interest rate falls and new bonds are being issued at 3%, then investors would rather have the older 5% bonds. If you like, you're able to sell a bond before that bond expires or matures, just like you're able to sell stocks. If you sold the original 5% bond, buyers are going to bid up the price of your bond since it's paying a favorable 5% interest rate. So it's very important to remember that bond prices and interest rates are inversely related.